All right, listen up. We are plugging directly into the matrix today because I've found a glitch, a huge anomaly in the code that the suits on Wall Street are desperately trying to hide. See, they're broadcasting one thing, but the data, the real signal, is telling a completely different story. So let's get into it.
Okay, first things first. The compliance shield is up. I am a space ape looking at glowing rectangles. I am not a financial advisor. This is just educational banter. It is not financial advice. You got to do your own due diligence or, and trust me on this, the market will eat your lunch. All right, now that we've got that out of the way.
So let's start with the central mystery, the big question. What if I told you that the biggest, most significant trades made by the so-called smart money are in complete contradiction to the advice they're peddling to you, to the public? And what if there's a hidden danger in just blindly copying what they do? We're about to find out.
And here it is, the glitch in plain sight. On one side, you have the official story. Goldman Sachs saying, we focus on turning global transformations into investing opportunities. Sounds impressive, right? Very sophisticated. But then you look at the other side, the actual data trail from their SEC filings. And what are they really buying? Millions of dollars worth of Crocs, beer, and the company that owns Outback Steakhouse. Global transformations, indeed.
This brings us to what I like to call the official suit narrative. This is the story they sell you. It's what you hear at conferences, what you read in their glossy reports, and what gets blasted on the financial news networks 24/7. It's the matrix they want you to stay plugged into.
And here's the best part. This isn't some random blog post. This is a headline from Institutional Investor, one of their own publications. It literally says that beliefs, not empirical evidence, are driving the market. They are admitting, right there in their own words, that the official story is built on hype, not solid ground.
So how do they sell you on these beliefs? Well, they hit you with a wall of jargon, things like private credit, alternative assets, AI disruption, asset allocation, model portfolio, strategic gaps. The goal here isn't to make things clear, it's the exact opposite. It's to make it all sound so complex that you feel like you need them to navigate it, so they can sell you products you don't even understand.
Okay, that's enough of their story. Let's unplug from that noise and start decoding the ape data. It's time to follow the real money, the trail they're hoping you're too distracted by all the buzzwords to actually notice.
And here it is. This is the real signal. If you look at the data Roma filings, this is what the super investors are actually loading up on. It's not AI disruption. It's not alternative assets. They're buying Crocs, beer, potato chips, sneakers, and railroads. Solid cash flow heavy companies that make real things people actually use. This is the real economy.
And this actually brings us to a key piece of our lingo, HODL. It just means hold on for dear life. It's all about having those diamond hands, believing in the long-term value of something, which, is exactly what these boring, profitable companies represent.
And why does any of this matter? Well, because of numbers like this one. Forget the stories for a second. According to company's market cap, Apple generates nearly $94 billion in pure profit. That is not a narrative. That is a literal mountain of cash. That is real. That is the signal you should be watching.
So, the crucial point here is this. Cash is king. Hype is just the jester dancing around the throne. The market can be totally irrational for a long time, for sure. But eventually, it always comes back to rewarding businesses that actually make money. The suits know this, even while they're selling you all the hype.
Okay, so this leaves us with the critical question, right? We see the glitch. We see the huge difference between what they say and what they do. So, is this our big opportunity to just follow the real money? Or is this some kind of carefully laid trap? You can really look at this data two ways. The bull case says, hey, just follow the flow. Ignore all their fancy public statements and just buy what they're buying. Profitable, established companies. Simple. But the bear case says, hold on, it's a rigged game. They might be buying these public stocks, sure, but they also have huge positions in private markets and alternative assets, and access to information you will never, ever see.
Which brings us right back to that question I asked at the very beginning. We see the data, we see the glaring contradiction. So what is the hidden danger of just blindly copying them?
Here's the answer. The danger isn't the stock pick itself. Buying a profitable company is rarely a terrible idea. The real danger is thinking you're playing the same game as they are. You're not. They are playing on a completely different board with different rules, different tools, and a totally different end goal.
And this leads us to the single most important takeaway from this whole decode. The real smart money strategy isn't about picking winners. It's about playing the odds.
You see, the suits sell you the idea of certainty. They want you to believe their model portfolios are the guaranteed correct answer. That's the lie. The ape's edge is embracing probability. It's understanding that the market is just a chaotic game of odds, and your only job is to consistently make bets that have a positive expected value over the long run.
So how do you actually get that edge? It really comes down to 3 simple steps. First, doubt the narrative. Question every single headline you read. Second, follow the raw data. Look at the SEC filings, not the glossy marketing reports. And third, and this is the most important rule of all, manage your risk. Because you can be 100% right on your thesis and still get completely wiped out.
Think about it like this. The market is absolutely a casino, but you can be the house. And you do that not by trying to predict the future, but by managing the probabilities so they're always in your favor. So here's the final moon or zero verdict. Is copying the suits the play? No, it's a trap. It makes you a pawn in their much larger game. The real alpha, the real edge, is learning to think like them, to see the market as a game of probabilities, not of predictions.
That's the glitch in the matrix. They want you out there searching for a magic bullet, a guaranteed win, while they're just quietly playing the odds. So the final question I'll leave you with is this. Now that you know the game is all about probability, which odds are you going to play next? Think about it.